it very much dependent on your investment knowledge. If you are the investor that who are able to take your cash, invest into liquid investment, invest into like ETF, share, unit trust, or whatever investment, and then you'll be able to get a return about 7 to 8 or 9% return annualized, then I would think it only makes sense for you to go for the option to not to settle the loan, not to use your cash to settle the loan, but invest the money to get higher return. Okay, why? Because the loan that you are having now maybe is only like 4%, 5% interest mortgage rate. So for that matter, to get a 8% or 9% return definitely is actually higher than the saving you can get from the 4+% of your mortgage interest rate. Okay, that's number one. Number two, if somehow you are an investor that can only put money in the bank, and the bank is giving you maybe about 3+% interest. Okay, if you put the money in the bank, you only get 3+ return. But if your mortgage that you are paying 4+% for the mortgage, then of course in this situation it makes sense for you to take the money you have in the bank, okay, to settle the mortgage loan, that costs you higher interest rate. When the government increase OPR, banks will also increase their interest on the mortgage. If your mortgage is the interest flexible, then for that matter, for you to finish paying your mortgage for the next 10 years and 20 years, then you need to pay extra repayment every month in order to do that. So for that matter, how to reduce it? Okay, it will automatically reduce it when the interest rate come down. Okay, that's one way. You don't have to do anything. Another way to reduce it is to refinance your loan, or to talk to the bank to say that instead of finishing paying it for the next 10 years, maybe I can finish paying you for another maybe 12 years or 13 years. Then at least I don't need to be burdened by paying extra every month, because that will upset my monthly budget and monthly cash flow. Reverse mortgage scheme is opposite of the mortgage that we normally use, because normally we buy a house, we take a mortgage loan in order to finance this property. Reverse mortgage is something which is opposite, whereby you have already paid up your house already. You are staying in a house, okay, for example, this house may be worth 2 million, but you find that you don't have enough income to maintain your retirement lifestyle. So, but you can't sell this 2 million worth of property because you're still staying into it. So what you do is that you will have a reverse mortgage arrangement with a reverse mortgage company, which is, I believe, approved by Malaysia regulator, and it's already been launched. Okay, now then for that matter, when under this arrangement, they will start paying you whatever income, but your ownership in their property will become less and less and less. Okay, and then they'll pay you throughout your lifetime and things like that. Okay, so this is the concept of the reverse mortgage. But again, it is similar to annuity income, whereby we need to calculate if the client were to give this 2 million property into this reverse mortgage, what kind of the income they're giving to you will come into what kind of return? Okay, is it something good return? Okay, or it is something whereby if you were to refinance, the property, okay, and then invest the money elsewhere, or you sell the property and then you invest elsewhere, that can give you a better return. So there are quite a number of financial planning consideration or different alternative to decide whether in your situation whether reverse mortgage is a good option for you.